Gold is front-running the CPI print, and the market is doing it with math, not emotion. The weird part is that a lot of people still want to pretend this is just safe haven vibes, or a headline trade like gold woke up one morning, got spooked, and decided to levitate. No. The move is happening because rate cut bets are shifting under your feet. Liquidity is thinning at exactly the wrong time. And there is a hidden pressure point in market structure that turns a normal bid into forced buying. And if you stay with me, I am going to give you the one zone on the chart that decides whether this turns into a clean retest you can actually manage, or a continuation squeeze that gaps before you can blink. Because if that one level breaks, the math changes. Most people think CPI is the trigger, but CPI is just the alibi. The real trigger is what traders do ahead of CPI, because the market doesn't wait for the number to show up like a student waiting for grades. It reprices probability. It reprices the path. And then it dares the data to disagree. That's where the pressure starts. You can literally see it in the way gold has been acting. It didn't just bounce it, stepped up into a higher range and kept finding buyers on dips that should have been sold if the market was truly uncertain. That tells you something about who's buying and why. And it's not your neighbor panic buying a coin at the mall. It's positioning, it's hedging. It's institutions managing a path they don't fully control. But that's not the part that matters. The part that matters is why the rate path is the engine for gold right now, and why gold can move before CPI even prints. Here's the clean way to think about it. Gold is priced in dollars, it yields nothing, and it competes with the risk-free path. When the expected path of policy rates shifts, even a little, you're not just moving a number on a screen. You're moving the discount rate. You're moving real yields. You're moving currency pressure, and you're moving how expensive it is to carry metal through futures and financing. All of that is market structure. All of that is plumbing, and markets live in plumbing. So when rate cut bets shift, gold reacts even if CPI hasn't spoken yet, because the futures market is already whispering. But there's a trap people fall into. They treat rate cuts like a single on-off switch. Either the Fed cuts or it doesn't. That's not how this trades. The thing that moves gold isn't the headline cut. It's the slope of expectations. It's the probability distribution. It's how far the market drifts from what the Fed is trying to telegraph. Because when that gap opens up, somebody has to hedge it. Somebody has to normalize risk. And that somebody often ends up buying gold, not because they love gold, but because gold is liquid, global, and it doesn't care which politician said what at 2 a.m. Now zoom in on the conflict that's forming. On one side, you've got the mainstream narrative. Wait for CPI, react to CPI, repeat the same 5 talking points. On the other side, you've got the market itself, repositioning in advance, shifting duration exposure, nudging Fed funds expectations, leaning into convexity, paying for protection, and quietly bidding up gold because it's the cleanest hedge against a messy outcome. And the messy outcome isn't just hot CPI or cool CPI. The messy outcome is volatility, because CPI week isn't just data, it's a volatility event. Dealers know it. Funds know it, macro desks know it. And in a volatility event, microstructure can dominate fundamentals for longer than people want to admit. That's where the real pressure starts. Now let's talk price behavior without getting hypnotized by the exact print on your phone. Gold has been living in the high end of its recent range and poking into record territory. And the key detail is how it behaves after those pushes. Does it instantly collapse? Does it puke back the whole move? Or does it hold a chunk of the gain and force sellers to work harder? When you see it push, pull back, and then find buyers earlier than you'd expect, that's a signature. It's not proof of a guaranteed moonshot. It's proof that the marginal buyer is patient and the marginal seller is cautious. And that matters this week, because CPI week is when marginal behavior gets punished. One bad candle and the weak hands dump. One squeeze candle and the late shorts scramble. But the market isn't driven by weak hands alone. It's driven by positioning, leverage, and the risk constraints that make people buy at the worst time. And that S, where the hidden detail comes in, the options market can force buying even when sentiment is split. Most people stare at spot gold like it's the whole story. It's not. Spot is the headline. Options are the engine room. Futures are the conveyor belt. And spreads are the lie detector. Because the options board doesn't care about your opinion. It cares about delta, gamma, and who is forced to hedge. Here's the plain English version that actually matters. When a lot of call options are bought at certain strikes, especially into an event like CPI, dealers often end up on the other side of those calls. That means dealers are short calls. When you are short calls, rising price hurts you. And the way you manage that risk is not by praying. You hedge, you buy futures or spot to offset your exposure. That hedge is called delta hedging. And the speed at which your delta changes as price moves is gamma. So when price starts drifting up toward those big strikes, dealers have to buy more as it rises, which pushes price up more, which forces more buying. It's reflexive. It's mechanical. It's the market chasing its own tail. And once it gets going in thin liquidity, it can feel like news is moving price, when actually hedging is moving price and news is just the story you tell afterward. That's the part most people miss. And it's the reason gold can react before CPI prints. Because the move isn't waiting for CPI. The move is waiting for the market to get pinned, squeezed, or released by positioning. And that's where the real pressure starts. Now, this is where skeptics roll their eyes and say, okay, so it's all options games. No, options are one layer. They're a multiplier. The underlying fuel is still macro: rates, inflation expectations, currency stress, and trust. But the multiplier matters because it changes the short-term path. It changes the pace. It changes the violence. And if you're a retail investor, pace and violence are what decide whether you get shaken out. So let's stack proof like adults. Layer 1, rate cut bet shifting. You don't need to memorize probabilities to understand the mechanism. When the market starts leaning toward easier policy, or even just toward a faster path of easing than previously priced, real yields tend to stop rising and can start sliding. Gold likes falling real yields, not because gold is magical, but because the opportunity cost of holding it drops and the currency tailwind can show up. Layer 2, real yields versus gold behavior. The interesting feature lately is that gold has been strong even with real yields still relatively elevated by historical standards. That is not supposed to happen if your model is gold is only an inflation hedge. It suggests there's a second premium being paid, the credibility premium. The I don't trust this regime fully premium. The I want insurance against policy mistakes, geopolitical shocks, and sudden liquidity events premium. That's not conspiracy, that's incentives. Big portfolios, hedge tail risks. And gold is a clean tail hedge when the alternatives feel politically or institutionally messy. Layer 3, futures market structure and term structure. Gold normally trades in contango, future prices higher than spot because of cost of carry, financing, storage, insurance, and the reality that $1 today is worth more than $1 later. But when demand for near-term exposure increases, or when financing dynamics shift, that curve can flatten. Even if it doesn't flip into dramatic backwardation like oil sometimes does, a tightening curve is a signal. It says, I want it now. And I want it now is not a vibe, it's a stress indicator. Layer 4. Physical versus paper tension. Paper sets the price, but physical sets the pain threshold. If the paper market pushes price down aggressively, that's when you watch whether physical demand steps in. Are premiums stable? Are large buyers stepping in? Do you hear about tighter availability in certain sizes or locations? You don't need perfect numbers to see the behavioral tell. When physical demand refuses to fade at higher prices, it puts a floor under paper sell-offs. That's a pressure point. Layer 5. Cross-market confirmation. If gold is moving for real macro reasons, you often see echoes elsewhere. A softer dollar, a change in volatility behavior, shifts in inflation break-evens, or a rotation in risk appetite. Not always in a neat textbook way, but enough to tell you this isn't just one isolated chart being crazy. And layer 6, the one that sneaks up on people, positioning and margin constraints. When a market grinds higher and refuses to give back gains, shorts don't just lose money, they lose risk budget. They get margin calls. They get told to reduce exposure. That turns I'll hold into I must cover. Enforced covering is the purest fuel there is, but that's not the part that matters. The next detail is what flips the whole setup, the calendar. People underestimate calendars because calendars feel boring, but calendars move markets because calendars move flows. CPI isn't just data. It's a date on which volatility spikes, liquidity changes, and positioning gets reset. Into an inflation print, dealers adjust hedges, funds reduce risk or buy protection. Systematic strategies rebalance. And if you're near month end or in a window where funds are judged on performance, behavior gets even more constrained. That's why now is not a philosophical question. It's literal. We're moving into a CPI window where the market wants to be positioned before the number, not after. Because after is when spreads widen and you pay up. After is when the first move is usually wrong and the second move is the one that hurts. So people get ahead of it. They front run each other, and gold, because it's liquid and globally traded, becomes the battlefield. Here is the simplest mental model for the CPI weak dynamic. The market chooses a lane before the print. If CPI comes in cool, that lane widens. Easier policy expectations, softer dollar, lower real yields, gold bid continues. If CPI comes in hot, the lane narrows. Yields up, dollar up, gold can drop hard. But even in the hot scenario, there's a twist. If the market is positioned too heavily for one outcome, a hot print can create a whipsaw where gold dumps, then snaps back as the market realizes the path isn't linear, or as risk aversion spikes anyway. because sometimes hot CPI isn't just hawkish, sometimes it's destabilizing. And destabilizing can still be bullish for gold after the initial hit. That's why this is not a one candle trade. It's a setup with 2 scenarios and a checklist. And if you don't respect that, volatility will make you its hobby. Now let S do the mechanism explainer you actually need if you're going to survive this. Dealers and gamma. Imagine the options market as a set of magnets on a table. Big strikes are big magnets. Price gets pulled toward them because hedging flows can accelerate as you approach. If dealers are short calls at a strike above current price, they are short upside convexity. As price rises, their delta exposure becomes more negative, so they buy to hedge, which pushes price up, which increases their need to buy. That is positive feedback. If dealers are long gamma, the opposite can happen. Price moves, they sell into strength and buy into weakness, dampening volatility. So the sign of gamma matters. You don't need to know the exact gamma number. You need to know the behavior. Does price accelerate into strikes and stay sticky, or does it snap back? If gold is accelerating upward into a CPI window, it often means hedging is adding fuel. And if you get a CPI surprise in that environment, you can get a gap, not a candle. Because if liquidity is thin and hedges are crowded, price can jump through levels before you can react. That's why this week isn't about being right. It is about being positioned so you don't get forced to do something dumb at the worst time. Because if this one level breaks, the math changes. Now, let's bring in the other side of the market. Futures and spreads. Gold trades as spot, but most institutional action expresses through futures. Futures have expiries, delivery windows, and roll dynamics. That means the market is constantly dealing with the question, do I hold exposure through a contract and roll it, or do I move to a different maturity? In calm markets, that roll is a rounding error. In stressed markets, spreads matter. If near-dated contracts start behaving differently than far-dated contracts, that's telling you something about urgency. It might be funding stress, it might be demand for immediate hedge, it might be a scramble to be long, the most liquid point on the curve. And when that happens, you'll see it in how price responds to dips. Dips stop being opportunities to sell. Dips become opportunities to reload. That's not a guarantee of higher prices tomorrow. It's a clue about the structure. Now, physical versus paper. This is where people get weird and go full conspiracy. Don't do that. Keep it mechanical. The paper market is enormous. Futures and unallocated exposures can move price faster than trucks can move bars. But physical matters because ultimately there's a real asset behind the abstraction. And when physical demand is sticky, it changes the floor. The clean way to talk about inventory categories without getting lost is this. Not all reported inventories are equally deliverable. Some are eligible, some are registered, some are in forms or locations that are not easily moved, and the willingness to deliver depends on economics and incentives. In stress, what matters is not how much gold exists in the world. It's how much is available at the margin at the right time, at the right place, under the right rules. When that marginal availability tightens, paper shorts can get more cautious because the worst-case tail becomes more painful. That's a subtle dynamic, but it matters. And it means one of the reasons gold can act strong even when mainstream models say it shouldn't T. But that's not the part that matters. The part that matters for you is what happens next week or two and what level matters. So let's talk levels without pretending we can draw the chart in your brain. The key zone is the recent breakout and retest area, the place where gold shifted from upper range to new regime. If price holds above that zone on pullbacks, sellers stop being traders and start being risk managers. They can't just try a short anymore. They have to respect that the market is accepting higher prices, that acceptance shows up as failed breakdowns, quick reclaim candles, and rising lows. If that zone breaks cleanly and holds below, the move turns from trend continuation into bull trap risk. And bull traps around CPI are brutal because they punish both sides. Longs get shaken out, then price snaps back, and shorts get trapped. So you need a 2-scenario lens. Scenario 1 is the controlled pullback and retest. Gold pulls back into that breakout zone, liquidity hunt stops, everyone panics for 10 minutes, and then buyers show up with size. The retest holds, volatility compresses. That's the healthy scenario. It confirms the thesis without needing drama. Scenario 2 is the continuation squeeze. Gold doesn't give you the retest. It grinds up into CPI, options, hedging intensifies, liquidity thins, and a catalyst, data, geopolitics, currency wobble, pushes it through a psychological level. That move is fast, it's gappy, it's violent. It feels good if you're already in, and it feels like a trap if you're chasing. And that's why this setup is dangerous. Both scenarios can be bullish over the medium term, but one is tradable and one is emotionally engineered to make you do the wrong thing. Because markets love to pay you in stress. So what confirms the thesis in the near term? First, gold holding the breakout zone on dips. Not necessarily never dipping below it for a second, but failing to stay below. Reclaims matter. Second, real yields not ripping higher. If real yields start climbing hard, it's like turning up gravity for gold. Gold can still fight it for a while, but it's harder. Third, the dollar not regaining dominant strength. Gold can rally with a strong dollar sometimes, but it's not the smooth path. Fourth, options-driven behavior. Acceleration into key levels and stickiness above them rather than immediate rejection. Fifth, evidence of persistent demand. Strong dip buying, stable physical tone, flows not collapsing on weakness, and what weakens or invalidates it, this is where you earn trust by admitting reality. If CPI surprises hot and the market reprices the path upward, meaning the expected policy path shifts to tighter than currently priced, you can get a violent drawdown in gold. If the dollar surges and real yields jump, gold can drop even if the longer-term story is intact. If gold fails to hold the breakout zone and starts printing lower highs, that's a change in character. If volatility collapses and risk assets rip while the market decides inflation is fixed, gold can stall or fade. And if you ignore those signals because you're married to a narrative, you'll get chopped. That's not pessimism, that's risk management. And if you're in metals, you already know. Price can whip around violently even if the thesis is correct. The market can be right and still hurt you. That's why you separate trend signal from noise. Trend signal is structure, higher lows, acceptance above key zones, supportive macro drift. Noise is CPI candle chaos, headline spikes, stop runs and thin liquidity. If you trade noise, you become liquidity. Now, here's the part you came for. What to watch next, concretely, like a checklist you can use without losing your mind. Watch the behavior of yields around CPI week, especially real yields if you track them. Watch the dollar's response to risk events and data. Watch how gold behaves into and after key levels. Does it reject violently, or does it hold and build? Watch implied volatility in gold options. When vol rises into the event, it means the market is paying for protection, and that can feed hedging flows. Watch the curve behavior in gold futures. Any unusual tightening or stress tells you urgency is rising. Watch broader risk tone. If equities are wobbling and safe haven flows are rising, gold's bid can be reinforced even if the data is mixed. And watch one more thing most people ignore, how fast dips get bought. Speed is information. A slow grinding bounce is not the same as a sharp reclaim. A sharp reclaim tells you someone had orders sitting there, waiting. And that's where the real pressure starts. Now let's address the institutional skepticism crowd, because I know you're here. You don't need to believe in manipulation to believe in incentives. You don't need to believe in secret meetings to believe in positioning. Banks, funds, and large players are not villains. They're constraint machines. They manage risk. They hedge. They defend VAR. They respond to funding conditions and volatility. If they can push price to levels that trigger stop losses and provide liquidity, they will. Not because they're evil, but because liquidity is their oxygen. And CPI week is when liquidity is most expensive. So yes, you will see moves that look unfair. But the solution isn't anger. The solution is the psychology shield. Here's how volatility gets used against you. First, a scary drop that makes you feel stupid for being long. Then, a snapback that makes you feel stupid for selling. Then, a grind higher that makes you feel stupid for not re-entering. That emotional whiplash is the trap. Your defense is pre-commitment. Decide your invalidation level before the event. Decide your time horizon before the event. Decide whether you're trading a CPI candle or holding a macro thesis. Because if you try to do both in real time, you'll do neither well. And here's the biggest hack. Treat CPI week like weather, not like destiny. You don't get mad at a storm. You prepare. You size accordingly. You don't stand in the open with a kite. You reduce leverage. You respect gap risk. You accept that the first move can be wrong. And you keep your powder for the retest, not the headline. Because markets love to punish impulsive certainty. Now, you might be thinking, okay, but is this just gold being gold because geopolitics are spicy? Geopolitics can absolutely add a safe haven bid, but notice what's different. The macro layer is already primed. Rate cut bets shifting changes the baseline. A geopolitical shock becomes an amplifier, not the origin. And in a primed environment, even small shocks can produce big moves because the system is already leaning. That's why you see gold react before CPI prints. It's not waiting for permission. It's reacting to the fact that the distribution of outcomes widened, and hedgers are paying for that. But that's not the part that matters. The part that matters is what you do with it. If you're a long-term holder, the message is simple. Don't let CPI noise bully you out of a trend. If you're a trader, the message is even simpler. Don't chase a CPI candle unless you enjoy paying spreads and donating slippage. Let the event pass. Let the market show its hand. Then trade the second order move, the retest, the acceptance or rejection. That's where edge lives. Now, I'm going to give you a clean, finance-credible way to frame targets without pretending we can see the future. Targets are not promises. Targets are zones where behavior changes. If gold holds above the breakout zone and starts building value above it, the next magnet is the next psychological round level and the prior high area where sellers previously defended. If gold breaks and holds below the breakout zone, the next target is the prior support shelf where buyers last proved themselves. In other words, you're not predicting a number. You're mapping where forced behavior might occur. And forced behavior is what moves markets. That's why this whole thing is about mechanics. Because the market isn't a morality play. It's a set of constraints colliding. And CPI week is when those constraints collide in public. So here's my base case, stated like a grown-up. Gold remains supported into CPI week because the rate path has been repriced enough to keep the bid alive, and because hedging dynamics are reinforcing the move. We get volatility around the print, we get a pullback or a whipsaw, and then the market chooses whether to defend the breakout zone. If it defends, the trend remains intact, and the next upside attempt has a real shot at follow-through. Here's the squeeze case. Gold continues higher into CPI with limited pullbacks. Dealers are forced to hedge upside exposure. Liquidity thins, and we get a gap-style move that overshoots, then consolidates at higher levels. That scenario is bullish, but dangerous because it tempts chasing. Here's the bear case you must respect. CPI surprises in a way that forces a repricing toward tighter policy. Real yields jump, the dollar surges, and gold breaks below the breakout zone and fails to reclaim. That doesn't mean gold is dead. It means the market is forcing a reset, and you wait for structure to rebuild. That's credibility. That's how you don't get emotionally farmed. And if you want the one sentence that keeps you sane through all of this, it's this. The thesis can be right and the path can still be violent. So size for violence, plan for violence, expect violence, and don't let a single candle rewrite your identity. One last thing, because this is where the skeptics of institutions crowd should actually lean in. Gold is not just trading inflation. It's trading trust. It's trading the market's confidence in policy, in currency stability, in the smooth functioning of the system. When that confidence wobbles, gold doesn't need perfect CPI. It just needs uncertainty and a repricing of the path. That's why it can move early. That's why it can stay bid even when textbooks say it shouldn't. And that's why the spread and the options board often tell the truth before the headlines catch up. The price is loud, but the mechanics are louder. So if you're watching this like a pro, here's your near-term roadmap in plain language. Going into the next week or two, respect the calendar, expect whipsaws, and focus on the breakout zone and the behavior around it. Watch whether dips get bought quickly or slowly. Watch whether yields and the dollar cooperate or fight. Watch whether volatility stays elevated into the print, because that tells you hedging demand is real. And most importantly, decide now what would make you change your mind. Not what would make you panic, what would actually invalidate the setup. Because if you don't choose your invalidation, the market will choose it for you at the worst possible time. And if you're the kind of person who likes seeing the plumbing instead of just hearing the story, you're already in the right room. Stick around, keep your eyes on the mechanisms, and let the headlines chase you for once.